core thesis is that, and this won't surprise any of you, but economic growth is unsustainable because rising populations and rising standards of living are putting increasing pressure on scarce natural resources, weak infrastructure, and creating pollution that hampers economic growth, future economic growth. And society's response to that is environmental legislation, which is aiming to reduce pollution and mandate the increased efficiency of natural resource use. And that legislation itself is facilitated by the development of environmental technology. So the development of legislation encourages investment in technological areas, and the development of specific technology makes the next level of environmental regulation more feasible. So our view of this sort of environmental opportunity is that this is what makes a difference, and an investment management team that is expert in those areas ought to be able to outperform. And so what we found in the last sort of 2 years, 18 months to 2 years or so, is quite a sort of intriguing perspective on that issue in a recessionary period. So way back in the start of the 90s, and even further back in the start of the 80s, when the last sort of serious recessions gripped the world, then the environment was really perceived almost everywhere as a luxury that society couldn't afford. It was sort of swept away in economically constrained times, and a lot of environmental legislation was sort of put on the back burner. What we've actually seen in 2008, 2009 is kind of almost the opposite, that probably the pressure on environmental resources, natural resources, has grown so great that politicians can no longer afford to discount this. And actually, with the economic view that fiscal stimulus should be short, sharp, and well funded, then it's been quite amazing how virtually every country that's got a fiscal stimulus package has put the green investment agenda right to the heart of that stimulus package. So from being sort of off the table and a luxury that society can afford, green has suddenly become mainstream and a must-have in your fiscal stimulus, and therefore the sort of Keynesian hypodermic needle to the economy is now green rather than black or red as it was 20 years ago. So take the solar energy industry. Okay, this is an example of how we think from a thematic basis. Back in 2006, early 2007, there was very strong demand in the European power sector for solar power because the German and Spanish governments had started to subsidise it. So anyone that could produce solar power was earning quite high returns, and so there was a real sort of shortage of supply because there's just not enough solar manufacturing capacity. So of course what that meant was that there was a huge incentive and price signal into the market to invest in solar module capacity. So the Germans in particular, some of the Americans and one or two of the Chinese companies quickly built up capacity, and there was a large amount of planning right all the way upstream to solar grade silicon as to where new capacity was going to come from. So watching the market from before that evolution happened and then seeing it evolve, we could project forward how the supply-demand balance was going to shift from the boot was initially on the foot of the suppliers of modules who were not enough for them, to shifting to the purchasers of modules, because suddenly all this capacity was going to come on stream. So if you look at how return on capital employed was going to evolve in that chain, you can see that it was going to shift from being high returns upstream to high returns downstream. So what that meant from a stock selection perspective is that we quite rapidly sold out of our upstream solar holdings and waited until the valuations had come down to sensible levels in the downstream part of the business, and started buying stocks downstream. So that sort of theme thinking, looking at the value chain of an industry, is a way that we filter 800 stocks down to 150 to 200, which is a sensible number. That then gives us a set of stocks which, in principle, were eligible for the portfolio, provided there's enough upside to target price. And we're looking for sort of 15 to 20% upside to target price over a 12 to 18 month period. So from that, we then apply another sort of rule or metric, which is that there's still a lot of stock-specific risk in this area. These are companies that are typically between $500 million US dollars and $2 billion US dollars, and therefore they are more prone to idiosyncratic failure, like management team disintegration, the collapse of a core market, the adverse movement of the regulation, than much larger companies would be that tend to be more diversified. So because of that characteristic of this marketplace, then it makes a lot of sense to diversify your portfolio. So we've got about 80 stocks in our environmental markets trust. The other feature of what we do is that we tend to take a medium to long-term view of the quality of our companies. So Vestas Wind Systems, for example, which is the leading supplier of wind turbines, we have held in our portfolio for 10 years without fail. It's never left the portfolio, but the weighting that we've had in Vestas Wind Systems has moved around as the share price has sort of moved relative to the intrinsic value quite considerably. When carbon assets were allocated in the European Union in 2005, two unintended consequences happened. First one was that because the permits were handed out rather than auctioned, then the utilities suddenly got an asset which they had to value, and they realised, because there was a lot of trading, that the assets had a certain worth. So they immediately marked up their balance sheets by the value of the assets they'd just been given, multiplied. The number of assets multiplied by the price, which is a few euros at the time, and suddenly went up to 30 euros temporarily. When they actually generated coal-fired power from that point on, they had to sort of effectively park these assets as they generated more power, because they needed to the end of the year to hand in permits in proportion to how much coal-fired power they generated. So what do? They added the cost, the value of the permit that they'd been given, to the price of their power. So the price of power in Europe went up because these carbon assets have been given out free, which is a completely unintended consequence. So what did that mean? Well, the poor old average entrepreneur running a business was suddenly paying more for his power than he had been doing before. There was no environmental benefit at all, because more permits were handed out than were actually needed in the system. So there's no benefit. Cost of electricity went up. Where did the value go? Well, it went to the pockets of the shareholders of the utilities. So in the UK alone, £800 billion was transferred from electricity customers to the shareholders of electricity companies because of the carbon system, for no environmental benefit. So the second problem that happened, which was probably foreseeable and it's now being rectified, was that nobody really knew what the emissions of carbon were before the scheme was created. And actually, whether you believe in the political manipulation of this or not doesn't really matter, but there were more permits handed out than were actually needed, given the actual emissions in the testing periods. And therefore, when we came to the end of the first period in 2007, guess what? There were more permits than were required. So the value of permits went through the floor. So if you look at the price of carbon between 2005 and 2007 in the European Union, started off at a relatively low number, went up to 20-something euros a tonne, and then came crashing down to virtually zero. That is a long-winded way of saying that it's all a bit sort of like magic, and we'd rather stay away from it as investors.